2014 year, and other 7,500 belongs to 2015 year. And now, please, guys, participate. You are again standing on 31st December 2014. And what happened? Interest revenue 900 has been earned but not yet received. What would be the entry?
Accounts receivable.
What?
No. Well,
Now what?
never mind.
What did you say? Please repeat.
Would it be accounts receivable?
Of course, yes. And then?
Okay. And then
Complete entry.
With it.
Sipide, Arone,
And service revenue. No, probably not. Because we're not servicing its interest, right?
So Misha, right?
Yeah, I'm trying to think.
Okay, you says the account receivable to interest revenue, right?
Well, it's definitely accounts receivable, and I don't know what. It's accounts receivable. Well, one is accounts receivable for sure.
Okay. Minsu, would you like to participate?
Sir, I think, oh, sorry.
No, I think it is unearned interest revenue to interest revenue.
Kim, how this is unearned? The question itself says that it has been earned. Unearned revenue, that they pay the interest in advance. They didn't pay in advance. Now time has passed. Now you earned the revenue, which is interest revenue. Sipide?
Sir, I also think it's accounts receivable, but I just can't think of interest revenue. I just can't think of anything else.
Okay. Aroni?
I also think it's account receivable.
Please speak full entry. What is the full entry, Aroni?
I'm not sure.
Please speak. This is healthy discussion. I'm not gonna judge.
Interest receivable and interest revenue.
Okay. Min.
I think it's interest receivable and interest revenue.
Okay, well done, guys. So here we go. Interest receivable to interest revenue. Since interest has been earned and interest revenue, the question itself mentioned that this is also belongs to sales, right? So when sales increase, credit. It is earned, it means you are not paid. So you create receivable. And what you have to receive? Interest. So interest receivable to interest revenue. Understand, Minsu?
Yes.
Okay, good. Now, please also mention this. You are again on 31st December 2014. Equipment was purchased at the beginning of this year at a cost of 50,000. The equipment useful life is 5 years. There is no residual value. Record depreciation for this year. So what would be the straight line method? Simply divide the cost minus the salvage value or residual value divided by number of years. So in this case, we have 10,000. Now, how much we have consumed this equipment? 10,000. So 10,000 is our depreciation. So how we are going to record it? Answer this. What should be the entry?
$10,000 depreciation. And,
Expense.
Yes, well done. Because we used our equipment for a whole year, so we call this expense. So depreciation expense to
Accumulated depreciation.
well done, well done. So because we say that we cannot charge depreciation directly, we charge depreciation to the contra account of the equipment, which is accumulated depreciation. So entry would be depreciation to accumulated depreciation. Right? So that the value on the balance sheet of equipment, it doesn't hurt. So that we know that what was the cost price of equipment. Yes.
I don't get it. Depreciation expense. I mean, which one of these goes in the assets?
This will go to the balance sheet. So, and it will go as, let me show you like that. So on the asset side, we have cash, marketable securities, others. So here going to be equipment. $50,000, and here it will be written as less cumulative depreciation, like this. Understand? So on balance sheet, so in this balance sheet, whether we are on which year, so we always know that we purchased the equipment for 50,000. So this is called the book value, which is the cost price minus the depreciation, all depreciation. We call this book value.
So we write
Like here.
a negative 10,000 in assets, right?
Wait.
Wait,
Yes,
could you go
because,
back? I think it was.
yes, because it is contra or opposite account of equipment. So it's already have a less here. Understand?
But the book value of equipment. Oh, and the book value of equipment also goes into assets, right?
Yeah.
Okay, yeah, because the equipment. Okay, yeah, I get it. Mm-hmm.
I think we already talked about I think that would be our slide number. We just talked about slide 25, right? 25. No. Here we go. Slide number 31 from our last lecture. So slide 31. Let me show you. So in our last lecture, we discussed that. So it would be shown in the balance sheet asset side as like that. Equipment, less accumulated depreciation, and then we have the book value of equipment, right? So all these three values shows different meaning. Okay. Here we go. So again, we are now on December 31st, 2014. And equipment was purchased at the beginning of this year at a cost of 50,000, determining the book value. Book value is the cost price minus its depreciation. 40,000. Right? And now construct the financial statements. We already know what are the formulas for financial statements, so let's talk about this. So this is the whole question that what we have done here, right? Throughout this chapter. So here we go. First, we need to make financial statement, and in financial statement, we have to make what? Income statement. So we'll go to our adjusted trial balance and pick the total amount of revenue, 7,500, and all the expenses, they are written on the adjusted trial balance. Here we go. Let me show you here. Right? So you have now all the data here. And for income statement, you need revenue, you have the revenue. Just pick the amount. You need expense, right? You just pick all the data from here. You don't have to go to the ledgers. For example, you don't have to go to here and pick out the balance, right? It's really hectic. So you make a additional statement, which is called trial balance statement or trial balance. And then you just put the figures over there, and you just, when you need that one, you just put the values over there. So income statement formula is revenue minus expenses. Here we go. So revenue minus all expenses. So all expenses are 4,000. And then we have taxes as well, 600. So 7,500 minus all the expenses, we have 3,500. From 3,500 you less taxes, this would be our net income. Now remember, after making net income, we make retained earning, right? So in our question, it is mentioned that